everybody. Uwe Jacobs, property friends, property strategist. Thanks very much for joining in, everybody. I'm pleased to welcome you. I've got Taimur Hussein with us. Taimur is a very stout mortgage broker. He's been doing quite a bit of work for us, for our team. So I will introduce to Taimur a bit later. It's great to see you all here. One thing I can promise you is we're going to have some fun. The ones that know me know that I like to be interactive. If you want to keep your camera on, that's fine with us. We are recording, so don't get into any compromising situations. It's amazing what has happened in the Zoom videos. There's quite some funny bloopers around, so be aware that we're recording. Alright, to a bit of housekeeping. We are going to do this as a virtual session, and I don't know about you, but I have certainly learned over the time that technology, as I call it, doesn't always do what I want it to do. If you want to keep your camera on, that's great. Don't be shy, but if you're not comfortable with it, that's fine. What I would like you to do is keep your microphone on mute. We will have 3 dedicated sections where we can interact and where you can get all your tons of questions shot to Taimur and myself. But it just makes it easier with the transmission bandwidth if you can keep your microphone muted. We have in the background Lenny, our assistant, sitting in the background. If you have any questions, don't hold on to them. Just whack them in the chat. So at the bottom of your screen there should be a chat icon. You just click on that and then you hammer away. If you can put your questions out to everybody. So if you can try that, hit the chat button and just say, hi, my name is whatever. And I'll see what happens. Hi Uwe from Max. Hello Max, good to see you. It's been a while, my friend. Who else is out there? Who else can find the chat box? Come on. Who have we got here? Jesse. Jesse and Jake, both of you. Fantastic. Thank you. Love you to be here. That's fantastic. Marcus, excellent. Great to see you. It's been a while, my friend. We should also have Frank there. Anyway, that's all good. So this is how it works. We'll use the chat box if we've got questions in between, please. And then we can reasonably go through the presentation. Okay. So we've just been through that. We will email the recording to you. So keep whatever notes you want to, but you don't need to write down the slides. They will be delivered to you by our capable Lenny tomorrow. So that's all good. And thank you very much for being here. Thank you for your interest. Much appreciated. Let's have some fun. All right. The first amount of fun is, this is obviously general information, so please take it as such. They made me do it, the usual disclaimer. Talk to your own advisors and talk to them about your specific applications. We both know what we're doing, both Taimur and I know what we're doing, and both of us have been in it for quite a while, but we cannot give specific advice. So we'll do it a bit different today. We'll make it really complicated. The how, the what, the with whom, the what next, and the why. Very, very simple. And yet, behind those very, very simple 5 points is a pot of gold. I just find a lot of people don't interrogate, investigate, look at that sufficiently. So let's go into it. And as I said, if you have questions, whack them in the chat box and we'll go through them. Now, the how. A lot of people ask me, how do you do these sort of things? Well, the first decision that we have to make is this a hobby or is this a business? Because as far as I'm concerned, and the people that know me well know that I am straight down the line. I say it as I think it. I don't mean to be arrogant. I don't mean to be stepping on anybody's feet. But I figure it is better to say it as it is and just let it rip. It's a lot more fun for everybody. So, hobbies cost money. Businesses make money. So my suggestion is to go with some very educated people who say, to the same amount that you can control your emotions, you can control your money. Meaning that the figures should be doing 90% of the talking, and the intuition, the gut feeling, the doing as the Joneses should be only 10%. A lot of people get driven by their ego, and that is not a good way to do business. Ulla and I have been in property investing for over 20 years, and we've always looked at this as a business. Taimur, as a mortgage broker, is looking at the figures, he's looking at it as a business. So let's look at it as a business. The more you can be unemotional and look at the research data. Hello? Okay, that's interesting. There's a phone going. The more you can look at the research data, the better it is. Now, research off-site is great. However, again, it's only one part of the coin. I'm a very strong believer in you gotta touch it, feel it, smell it. Either yourself or get somebody that you trust, that knows what they're doing, to touch, feel, smell the market, to be in the market. And what I generally say, and again, I don't have a chip on my shoulder, I would like to think, but there is no way I can explain to you and sell you a property all over the East Coast. Because quite frankly, I can't know the whole East Coast. I can know 3 to 5 markets inside out, and that's the way to get the last $10,000 out of it. Now, if I know a market inside out, then I need to do on-site research. So very, very important, either do it yourself or find somebody that you trust that can do it for you. Let the figures do the talking, but also do the walking. Pound the pavement, get the feeling for the joint, because a lot of things can only be interrogated, investigated, found out once you really are on site. I hope that makes sense. I'd like to think that every business has a system, because systems create duplicatable and predictable outcomes. Property Friends certainly has got a 7-step success system where we educate, we inform with accurate, unbiased data, we train and we mitigate risk. Now the last point I think is also a very important point. Mitigation of risk, but we'll get to that. I've just covered that. So, why high rental yield? People always, if I had $1 for every time I had the question, What's more important, rental yield or capital growth? Well, I say both. And the reason is the rental yield is necessary for lifestyle. It provides the cash flow. Now, I don't believe in buying a property in, let's say, Albert Park for $1.5 million, and that's a shack, and getting 2.5% rental yield on it. That means that you're paying about $1,000 to $1,500 a month of your after-tax income towards that sucker. I call that feeding the dragon. There's not many people that can do that, taking, let's say, $1,000 a month from their after-tax income and still live. But there are even fewer that can do it 2 or 3 times. So the short-term income, the cash flow, is really, really important. And the cash flow is the rental income. Taimur, I'm sure, will cover a few words on it. In regard to financing, if you're too negative, you may be able to get 1 property, but you're certainly not going to get 3, 5, or 10. Now, again, people come to us for 3 reasons. They want to have diversified independent income, they want to have choices in retirement, or they want to leave a legacy. Now, you don't do any of those 3 with 1 property. So it makes sense, doesn't it, to look at the cash flow and to look for properties that have got high enough cash flow so that you can build a portfolio. It is the small money. The big money is made in the capital gains, no question. But you need the small money to live. And how do I know that? Well, I've tried it. But just imagine the situation of Sydney. 7 years, no capital growth. For 7 years, you're sitting there paying the dragon, feeding the dragon. I don't know about you, but my subconscious would say to me, why are you doing that, smart? This is not paying off. You're not going on holiday anymore. You're not having any dinners with your partner anymore. All you do is feed the dragon. And then the worst thing is, after 6 years you go out, you sell, and promptly the next 3 years the property goes up 70%. You can't time the market. I don't think anybody can. Yes, we can find indicators, but nobody with high certainty can time the market, predict the market. So that means, as far as I'm concerned, we're better off with a good steady income where the property pays for itself completely at 100% calculatory interest. And we can still live. And we can live just as normal as we do otherwise. That is the trick. And that is the trick with being able to also fund a portfolio. Because the banks will keep on giving you money, lending you money. Not if you're $1,000 minus per month. For sure not. Anyway, so we need the small money to get to the big money. So, capital growth. Well, capital growth is the big money. No question. The capital growth will ultimately pay for the repayment of the loan and some. The capital growth is where the big money is made. No question. But you want to have capital growth developing over time so that you can then either retire part of your portfolio to reduce debt, or if you have a rising debt strategy, that is also possible. That goes a bit beyond what we want to do tonight, but there's many options. But we do want capital growth because that's where the big money is made, for sure. For the refinancing, you take the capital growth. We have some people here right on the call that are doing that just now. They bought their principal place of residence. The principal place of residence has gone up, so their family home that has gone up, they're going to have it revalued, draw some money out, use that as a deposit for an investment property. So we have taken the big money, the capital growth, and now we start to multiply it or even exponentially make it work for us. See, why would I leave good funds that I can make work as hard as I do in my principal place of residence and not do anything and make the suckers work? I work hard. I want my money to work hard. There's many ways to do that. I just happen to think that property is one of the best ones. And that's been proven time over time. Okay. Capital gain is the big money. Just imagine, okay, let's say that I get $200 a week in positive cash flow on the rental yield, which is huge. Now, let's make my math easy, times 50 weeks a year is $10,000. Take a $500,000 property that goes up 10%. What's that? 10% of 500 is 50,000? What do you want? 10,000 or 50,000? This is why capital gains is where the big money is made. But we need both, people. We need both. I see too many property investors that get stuck on one or two properties because they simply can't afford it. Okay, so why do we need both? Well, I've been droning on about that. You need the short-term money to get to the long-term money. You need the small money to get the big money. You need the rental yield to live and to live comfortably. Why not set up a property investment portfolio, not just one, a portfolio, ideally, where the property pays for itself completely at 100% calculatory cost? Because the, let's say, 20% that I take from elsewhere need to be paid for by the investment income as well. Oldest trick in the book that the marketeers will tell you, no, we don't need to allow that in the finance calculation. Yes, you do. So as far as I'm concerned, the property should pay for itself completely under all cost at 100% funding. Okay, so how do we do it? What do we do? As far as we're concerned, and Taimur is very good in that as well, it's all about you. My wife and I have been in property investment for 20 years. We have done many, many different things. I can today get you a deal that is 5% rental income, which will make it cash flow neutral, and will have 5-6% capital growth. I can shift that equation into forecasted incomes or market growth. We have properties that do 12% rental yield at government-backed rent. We have properties that have forecasts of in excess of 20% in the next 18 months. Now, is that guaranteed? No, nobody can guarantee that, and don't let anybody tell you that they can. But we've got the runs on the board. Have a look at our testimonials. We've done pretty good in our forecasting. But all of that means diddly squat. That's a nice technical expression. It's all about you. Because it doesn't matter what I want or what I can do. It's all about what you want and what you can do. And that means getting the information, doing the due diligence. So, as far as I'm concerned, it's about 3 questions, and I'll give you one bonus for afterwards. The first question is, where are we at? There's too many people that don't know where they're at financially and in their mindset. And that includes not only where is my assets, my liabilities, i.e. what do I own versus what do I owe, but also what's my income and expenses, and what's my mindset, what's my risk profile, what's my time frames. Why do I want to do this? Am I after choices in retirement? Am I after leaving a legacy? Am I after having an independent income, not having to get up to the job or to my business? What drives you? This is the important part. Not what I have in stock, which is typically the agents or buyers advocates do. They look at their stock list, that is as long as their arm, and they go, 2-minute discussion with you, and then they go, oh, this is you, which is just the property that they need to sell first. Wrong. We are big and strong in doing personalized, customized strategies. And the big one is, what's the end goal? Why do it all? What drives you? If we don't know what the end goal is, we're unlikely to get there. Then we develop a customized multi-property strategy. We all start with one. But quite frankly, my goal for everybody is minimum of 3 properties. You're the driver, you determine. But why not set it up for that? Why not have that in the forefront of our mind? Makes sense in my books. So what do? We look for balance and yield. I strongly suggest you look at a 5 better 10-year time frame and a 5 to 10 property strategy. Now some of you will go, whoa, 10 properties. How are the Jack dish? Jack dish is a technical term. Do we do that? We can do that. We've done it many, many times. It's about the system that facilitates that. And don't let anybody tell you that it can't be done. I've got too many examples, too many people that you can talk to that have done that. What's the old saying? Those that say it can't be done shall not stand in the way of them that are doing it. Love that. Okay, risk versus reward. That's what we need to look at as well. What is the right deal for you, for your personal circumstances? That's what it's all about. And that's the reason why we offer a no-charge 30-minute discovery call. My suggestion is book one in. What have you got to lose? 30 minutes of your life. What have you got to gain? If what I'm saying is right, and it is, lots. So, yeah, I invite you to book a free discovery session. So at this point in time, I think it's a good point to stop. Do we have any questions? Have we got any questions in the chat bot at the moment, Lenny?
Yes, we have one question from one of our attendees.
Yeah.
How do you know if someone is ready to invest in property?
Oh, good question. How do we know if somebody is ready to invest in property? Well, there's a couple of things that I would look at. And it really gets back to the 3 questions. Where are we at? Where do we want to go? And then we can develop the strategy. So, where are we at? Do we have access to ideally 20% of whatever we want to buy? So let's make my math easy, $500,000 property. Do we have access to 20%, which is $100,000? That doesn't need to be saved money. That can be in other assets that have grown, like my family home. That can be a joint venture or subsidy by mum and dad or by Aunt Maud. We don't need to necessarily have 20%, but that's the ideal, because under 20%, we're paying for the additional risk that the banks take on, which is called lender's mortgage insurance. And there is also a difference between property investments, LVRs, loan to value ratio, and investment property loan to value ratio. You can get property investment up to 85, 90, I have even heard 95%. But know that the more you go higher with the LVR, with the loan to value ratio, the more you get borrowings, the more you pay in insurance to the bank. And the bank insures itself, not you. So that's something to be considered. Once we know whether we've got the 20%, let's say 10 to 20%, we then can look at the other salient issues. What's your risk profile? What's your time frame? What do we want to achieve? And then we develop the plan. So yeah, it's a personalized question. It's a situation that needs to be looked at one-to-one. So whoever asked that question, by all means, book a discovery session. Anything else at this stage, Lenny?
None at the
No?
moment.
Okay. To the participants, if you want to open up your mic and ask a question, we will have a big Q&A session at the end. So if there's some immediate questions, otherwise I'll hand over to Taimur. And yeah, my suggestion is to kick on, and I'll hand over to Taimur. Please go ahead, Taimur.
Hi everyone attending the seminar, the webinar. Well, I'm the mortgage broker on the call. Been in the industry for last 8 years, running my own mortgage broking business for last 5 years. Predominantly specializes in investment properties. So my area of expertise is to find out ways where we can get some equity out of the property or find a solution for your next investment property. So the reason on the call is to introduce myself firstly, and I work with Uwe very closely. So introduce myself and also take questions if you have any in terms of how to start your investment journey. If you're already on the investment track, how you can fund your next investment property. Things to consider when investing is purchasing a property with no cash. So if someone who's a first investor, and I know it's a daunting task, or people get nervous when they start investing. So I guess, and don't realize that they can actually buy their first investment property with absolutely no cash. It can be done through, it can very easily be done through the equity in your property, and also use that equity to buy the property, at the same time reduce your tax bill as well. So people who are on a high tax bracket, I'm not an accountant, but working in the investment space, I do know that by using the equity from your property and using that as form of deposit and stamp duty, you can claim the interest that you have incurred on that portion, which means if you're buying something, let's say for 500,000, and you're spending, or you're taking out 100,000 as an equity from your property, technically speaking, you're claiming interest on the full 500 instead of just on that 400,000 which you're taking out otherwise from the bank. Where people go wrong on this is they try and save up money and then put that money as a deposit, which you can claim it down the track as capital gains or capital losses, but not, or capital contribution, but not on monthly basis, because there's no interest on that particular amount. So there is no negative carrying feature in it. The other thing which is very important, and as the slide says as well, is the structure. It's very important to have your structure right, both for tax purposes and for future investments as well. So if you have your structure correctly done, or if you have the right structure, both on your investment and owner occupied property, it would take you a long way. And it's like making a loop or a chain out of the other. So use your first owner occupied property to buy your first investment, and then the first investment to buy the second investment. But the timing have to be spot on, and also the structure needs to be spot on as well. Thirdly is a lot of people think that buying an investment property would be a debt that you don't want. Actually, it's a good debt, and your home loan is, or your owner occupied loan is considered as bad debt. The reason for that is any expense that you do on the investment property, or any and that could be an interest charge or depreciation, agent's commission, anything that you spend on that investment property, you can offset it against your income, which means at the end of the year, you can get a chunk of the tax return out of the tax return that you can. And that also helps you to buy next property because of that depreciation, because of that negative gearing, or positive gearing for that matter. But it is considered as good debt. And your home loan, because you can't claim anything on your own owner occupied property, you don't get any tax benefit on it, which means it is considered as bad debt. So this is where misconceptions are, and people think that having a home loan is a good debt and having investments a bad debt. That's the other way around. These are the things to consider. There are a lot many other things that should be considered while investing, and everyone have a different structure. Everyone have a different priority. Some people want to build a portfolio of 10 investment properties. Others don't want to go beyond 2. So everyone have their own agendas in life. So it's very important to have a detailed discussion with your mortgage broker, with your property investment strategist, with your accountant at the same time, and see what structure you should have. And you need to review your mortgages every 2 years just to see if there's a better deal out there for you. Is there's anything better that you can do on your portfolio? Is there another opportunity that you can have? So these are the things that you need to consider while you're going into the investing stream. And obviously, with Property Friends on your side, that's going to help you build that portfolio and obviously keep you on your toe. Any questions from me? I'm open, no problems. No asking.
We have.
Go on, Lenny.
We have a question from Kaiser. Sir Kaiser, would you like to go ahead and ask your question? You can unmute. You want to unmute?
So I've just written 2 questions. If you can see, please, and answer.
All right. His question is negative gearing finishing in near future? Any idea? And what is the maximum investment property one can buy?
Well, it's not set on the stone that negative gearing is going to finish in future, and negative gearing would still be there because it is one of the reasons people invest, to reduce their tax bills. So it's not set on the stone that negative gearing is going to finish. People use it for their own personal agendas, to promote their own personal properties and their own strategies. But I personally don't think that it can happen in any time near future or in further future as well. To your second question, what is the maximum investment property one can buy? It all depends on your personal circumstances, like what's your income, how much you're earning, what's your how many dependents you have, what are the commitments you have, like financial commitments you have, like credit cards, personal loans, car loans. And it's not just one thing that contributes to your borrowing capacity. It could be a combination of 2 or 3 or 4 different aspects to your personal income and expenses. At the same time, depending what kind of investment portfolio you want to have as well. So somebody wants to buy an $800,000 investment property, And whereas he can buy 2 or 400,000 investment property or 500,000 investment property. So that's the other thing that you need to consider while making that decision. So it depends on person to person and circumstances to circumstances. So everyone have a different circumstances, different set of moving parts to their story. So it's very important to book in one-to-one session with your mortgage broker or your property strategist to find out what can be done into your particular circumstances.
Do you mind if I jump in, Taimur?
Sure, we go for it.
Very interesting question about the negative gearing aspects being abolished. That Keating tried it between 92 and 94. It created an absolute rent increase because people felt it was no longer worthwhile to invest in properties. So that created a shortage and the rents went through the roof. There was no incentive anymore for people to invest. So in short, after about 18 to 20 months, he abolished it again. i.e. he allowed negative gearing or gearing against property investment again. The way that I look at it, there's too many politicians that have too many property investments to cut their own throat.
True. Very true. Very true. Very true.
And we have quite a culture in Australia, quite a love affair with property investment. So the uproar that would be created by trying to abolish it, I can't see it happening. It's a bit of saber rattling. Now, the other point that I wanted to jump in, and this is a nice small group, so allow me to do that. It will help other people as well. In theory, I can go out and buy a property for $1.5 million. I would caution anybody against that, because think about it. Property values are a pyramid. The more you get to the higher echelons, the less people can afford that. And I would rather, it's the old story, would you rather have $1 of 100 Coca-Cola vending machines or $100 of one Coca-Cola vending machine? I believe that the diversification of the 100 machines is better. I believe that the diversification of buying $300,000-$500,000 properties is better than one of 1.5 million. Why is that? Well, not only is the amount of tenants that you can choose from or that can rent your property a lot smaller at 1.5 million, while there's masses at 500,000. But also, if and when you want to sell, there are a lot fewer people that can afford a $1.5 million property. So that goes back to risk mitigation. Now, the last point, and I get carried away, so I will stop there, is diversification is risk reduction. Let's go for that word. Mitigation. Not only do you have 3 different houses, but I would even suggest to put those 3 different houses in 3 different towns. Again, personalized strategy. What is your thinking? What is your risk reward? What is your lifestyle? Lots of things to discuss, but I hope that helped. Did that sort of answer your question?
Yes, thank you. Thank you very much.
Okay.
There's
All right,
another one. I
Yeah.
think that's it's relevant as well.
Sure.
So is there any age limitations for loans in Australia, therefore must be paid off by the age of 65? Well, there is an age limitation, and you're right, it's just around 65. But with the investment property, banks look at the exit strategy more than anything else. So if you have a good super balance, if you have an exit strategy, proper exit strategy, that should not be an issue. So for example, if your exit strategy is that you're going to buy investment property and sell it in 10 years time and pay off the complete debt, bank would be happy with that. So as long as you have a proper exit strategy, it should be fine. And with some of the lenders, they don't even ask for exit strategy when it comes to investment property, because that's something that you can always sell and pay off the loan. So they don't really care about the exit strategy in that cases. But for the owner occupied property, yes, they need an exit strategy if you're close to that age. I hope
All
that
right.
answers the question.
I've made a promise of getting everybody out here before 10 o'clock. Just kidding. So let's kick on. It's unless there is, I'm just looking at the, no, I think we're right. All right. With whom? Well, allow me to indulge. We've been in business for 20 years. I'll make this quick. 76% of our business is return clients. That is also one of the reasons why I went to Taimur and why we're working with Taimur. And by the way, just for the avoidance of doubt, there is not a dollar that changes hands between Taimur and ourselves. We work together because we're both good at what we do. We serve our clients. That's what I want from what I call my strategic alliance partners. So, and that is why 76% of our clients are return clients. Our 7-step success system provides accurate, unbiased investment guidance, training, opportunity, and we mitigate risk. We have full disclosure, so we don't buy and on-sell. We negotiate on your behalf at a wholesale pricing level. And we get paid by you for a figure that we openly disclose, that you will know, no questions asked. I don't have any secrets. With friends, and that's why we chose the name Property Friends 20 years ago, you deal with open cards. You put the cards on the table. Isn't it a bit of a conundrum? Conflict of interest? How far do you want me to go? If I, as your advisor, get paid by the builder or by the developer, whose interest really do I look after? Generally the one that pays me. Now, we also wanted to cover off another point, and that is for you to clearly know how much we get paid, and for you to clearly establish whether you think it's worthwhile doing it or not. Because if I can't pay for myself through the cost reductions or savings in the transaction, why would you use us? And that's why we don't have any issues disclosing our figures. Everything is above board. Check out our client feedback and testimonials. If I can indulge myself for a second, I'll play a 2-minute video.
My ambition with this my first venture into property investment was to alleviate the difficulties I'd had previously with trying to accumulate some wealth. Superannuation had crashed and banks were useless. So I thought, and after talking to Uwe and Property Friends and their mission, I thought this has got to be the way for me to go, and to get a decent return on my hard-earned cash over the last 40 years I've earned. So I hope to gain out of this. I hope to get a good capital growth. I hope to be able to use the capital growth to go into more investing and hopefully stop working in the rat race within the next 10 years. The most important outcome of this project has been that I now don't have a fear of investing. I was very fearful of throwing my money into something and I wasn't quite sure, but Property Friends has taken that fear away for me. Once I get this settled and it looks like it's doing whatever I expect it to do, I'll be talking to Uwe and Ulla again, and we'll see what we can do again. I've had a couple of friends ask me what I'm doing with my life, and I've of course been pretty proud to tell them that I've got an investment property happening, and they've asked, should they, why would I talk to someone else? Why didn't I do it myself? So I've said to them that that if they're thinking of investing, all they have to do is give Uwe a ring. He will tell them all they need to be told over the phone. If they meet with him, they'll understand what sort of people that they might be dealing with, and that gave me, and I would be sure gives them a warm and fuzzy feeling. and would give them the confidence to let Uwe and Ulla and property friends handle any investment property for them.
Yeah, look, this gentleman, Mick, was quite risk averse and was quite timid at the beginning.
My ambition with this
And
my first venture.
we've been there. So my suggestion again is book a strategy call. It doesn't cost you anything, there's no risk. And there's so much to be gained. Mick doubled his money. He's sitting on $500,000, in excess of $500,000 equity as at this point in time, after 9 years. So, you know, why not you? That's the question. Okay. Do we have any more questions, Lenny? Or I'm happy to take the questions also. If you want to open your microphones up, by all means. Or do we have any more questions in the chat, Lenny?
Yes. You seem to go more into regional areas rather than metro. Why is that?
Oh, that's somebody that knows us. Very simple. Big capital cities typically have lower rental yields. I want to have everybody safe in our team. I want everybody to be able to go out for dinner and go on holiday and live their life normal. If I want to say it in a highfalutin way, return off my money is more important than the return on my money. In other words, let's talk in pictures, the turtle wins the race, not the hare. I rather go a bit slower and can live my life and have my lifestyle as I used to before my investment than kill myself with a big negative gear, excuse me, in the hope of getting a good capital gain. Now, the larger country areas typically provide a better rental income, and they can also provide great capital growth. One example is Cairns. I really like Cairns at the moment, and we pick 3 to 5 areas per year. Why do we like Cairns? Because it's been very risk averse, even through the pandemic, and being largely a tourism-driven town, with a good percentage of its income to tourism. We had, out of 65 properties that we have in the team, 3 that asked for a rent reduction, 1 that got a rent reduction. So the market is very, very stable, very, very risk averse. And we've made some excellent capital gains. Rental yields are sitting around 5.5%. So that will put a bit of cash flow into your pockets. Not much, but it's nice to have a bit of a bonus. There are many larger country towns where you can do that. It's next to impossible in the capital cities. That's the reason why we do it in larger country towns, from a strategy point of view. Was there anything else, Lenny?
Yes, one for Taimur. What are the advantages of positively geared property?
Right. So, as you know, they're basically negatively geared properties and they're positively geared properties. So it depends on the personal circumstances how comfortable you are with the investment scenario. So if you are someone who's paying, say, $40,000 in Texas, negative gearing is something that will suit your portfolio, and this is just purely based on the tax side of things. But if you are a bit conservative, or if you're not in that tax bracket, positively geared properties are great in a way that you'll get the cash surplus at the end of the month, which would cover some of those costs that you need to lay out from your pocket in terms of insurances, agents' commissions, and stuff like that. And it covers the mortgage as well. The second thing is when you have a property that is positively geared and you're looking to go on to buying the next investment property, that will help you to increase your borrowing capacity, whereas a negative geared property will bring your borrowing capacity slightly down. The third biggest advantage that I feel is during the current pandemic situation that we're in, circumstances of people have changed, and if you have a positively geared property, it won't impact you as much as a negatively geared property, because the property will be taking care of itself instead of you, or you have to contribute to it. So it helps in that way. So that's why I think it's a good time to have those kind of arrangements. And besides that, the interest rates are all time low. Most of the properties, smaller properties, not when I say smaller, the properties with lower mortgages, are positively geared anyways, because the interest rates are all time low. I hope that answers the question.
Yeah, that is whoever asked the question. If you've got any more on that, put it in the chat, or happy to open your microphone. Is there anything else?
Uwe, I've got one.
Yeah, go
So-
Marcus.
Yes.
How are you?
I am well, thank you. Do you have any positive cash flow properties versus your positive geared properties?
Yeah, we do. Let's just clarify whether I understand your question correctly.
Mm-hmm.
For me, a positive geared property is a property that pays for itself under inclusion of all cost and interest at 100%. Positive cash flow, some people call that neutrally geared, some people call that positive geared, whatever. Positive cash flow is a property that after all expenses, everything, throws good amounts of money into your pocket. Is that the right interpretation, Marcus? Is that what you're thinking?
It's not incorrect. I was looking slightly differently in that positive geared is with your taxation and depreciation, you end up being ahead, whereas
Okay.
positive cash flow means you just have more coming in than going out, regardless of your tax position.
Okay. All right. Yes, I see it pretty much the same. So positive gearing is you use the non-cash deductions to get to a zero or better position. Positive cash flow, your rental income is far in excess of all cost, even after the non-cash deductions. The short answer is I can give you an 8% net cash after all cost property. Let me say that again, 8% net cash after all cost. Does that match your risk profile? I don't know. Is it a specialist investment? Yes. As always, Marcus, the higher you go up the tree, typically the more the risk increases. There is a risk and reward equation, just like with the rental yield and the capital gains. Is that the best investment for you? There's only one person that can decide that, and that's yourself. Love to sit down with you and look at what your thinking is, and we can have a chat. We have properties in all sorts of applications, in all sorts of areas. That's what I consider our strength, Marcus. I fit the property to you and your strategy. I don't fit you to the property that I have got. That's the difference.
Thank you.
Does that answer your question?
Yes, it does.
Thank you. Anything else? Going? Do we have anything else, Lenny?
None so far.
All right. Well, thanks very much. We are happy to take any more questions. Just send an email. Lenny, if you can put both of our websites and emails into the chat, and we will also give you the contact details of both of ourselves in the recording email. So you will certainly have our contact details. Thanks very much from my side. It's been fun. I trust you got some more knowledge out of this. Taimur?
No, it's been a good group and good session. People have asked the right questions as well, and yeah, feel free to reach out if you have any questions. If you're looking to get your your properties valuations done, or check your borrowing capacity, or see what would be your next investment or borrowing capacity would look at, no problems. More than happy to help out.
Okay. Thanks very much for joining in, Taimur. That was good fun. And I wish you all a good night, and let's have a chat. Thank you. Bye-bye.
Guys, good night. Cheers.